After helping hundreds of people transition to retirement, I've noticed that many people anchor their retirement to a specific number that they want to have saved up. For a while, that number was $1 million, but with the inflation we've seen over the past few years, more and more people are thinking that number is at least $2 million or more. In today's video, I'll be walking you through a case study of a retirement plan for a couple that I now work with who thought they would need at least $2 million to support the lifestyle that they want in retirement. But after making a few adjustments to their plan, the reality was they didn't need anywhere near that much, saving them years of extra time working jobs that they didn't love. Before we dive in, if we haven't met, my name is Jake Skellhorn. I'm a certified financial planner and the co-founder of Spark Wealth Advisors. We're a tax-focused financial planning firm helping people across the country retire with confidence and minimize their tax bill. So here's a bit of background on our clients who we'll call Sarah and Ian. So Sarah and Ian are 58 and 60 years old respectively, and they currently have $1.4 million saved for retirement already. Of that, about $650,000 is in their pre-tax accounts, so their company 401ks and traditional IRAs. They do have a good amount saved in Roth accounts as well. They have $250,000 between them there. Then they also have about $500,000 in a joint brokerage account. For those that are not familiar, these are just ordinary investment accounts that don't have any special tax treatment. But we'll explain in just a minute how this is going to help their retirement plan and a little bit more about the tax implications. That's what that sort of asterisk is here. Of course, they will have a Social Security benefit as well. Their projected benefit at age 67, which is their full retirement age, is $2,800 for Sarah and $3,100 for Ian. Now, if they decide to claim early in any of these scenarios that we're going to go over, obviously we will reduce that to factor in the reduction in their benefit. And if they decide to claim later at age 70 or so, they will get a higher benefit than that. And they also don't have any debt. So they've done a great job to pay off their mortgage as they approach retirement. They don't carry any credit card balances. So that's going to be a huge component in the viability of their retirement plan as well. So Sarah and Ian's goals are to retire at 65 is their initial plan. And the main reason that they're thinking 65 is because that's when they will be eligible for Medicare. They're not really sure how health insurance would work or how expensive it would be if they were to retire before that. So that's kind of why they attached to 65 as their primary goal. They also felt that that's about the age that they will meet their $2 million goal for retirement savings based on their current savings amounts and a modest rate of return between now and then. But when they retire, they want to travel pretty extensively for the first 10 years or so. They have some trips planned to Europe and South America, but they understand that in the middle part of their retirement, they're probably going to slow down. So they'd rather plan to spend a little bit more up front, knowing that they're not going to have to spend as much later when they become less mobile and they aren't spending as much on flights and hotels and things like that. Other than that, their ongoing expenses for retirement, they expect about $80,000 per year. At least that's what they would like to be able to spend just on discretionary expenses. At home, living life the way they want to. They also want to keep their taxes to a minimum in retirement. They've done a fantastic job to accumulate as much as they have in their company 401ks and those Roth accounts, but they want to make sure that they're withdrawing from them in a certain sequence and order that keeps their taxes low when it matters most to them. And lastly, they do have 2 adult children that they would like to help out if they can afford to. But the main thing here is that they don't want to just leave them a bunch of money after they die. They want to be able to give money to their kids if possible while they're still around to see them enjoy it and not in their later years when they could probably use it, earlier on in their lives. So that was another goal that they had mentioned to us. And then just a couple plan considerations here before we dive into the software where we can look at all their numbers. The brokerage account they have has a pretty high cost basis. So in those brokerage accounts, your cost basis represents money that you've already paid taxes on. You only pay taxes on the gains in those accounts. So their cost basis overall is about $400 of that $500,000 or so. And that means for every $5 that they take out of that account, $4 is not going to be taxable and only $1 will be taxed at long-term capital gains tax rates. So that's going to provide a ton of flexibility for them when they need to start pulling money out of each account to support their living expenses. Once again, they do expect their spending to slow down after those travel years. So they want to plan for spending, not extravagantly, but a higher level of spending in the early years of retirement and then kind of cut back later on. They're not quite sure how they should be invested. They've been pretty aggressively invested throughout their careers, in the stock market to see that growth potential. But as they approach retirement, they want a strategy that's going to kind of soften the blows of any market volatility and provide that safety net for living expenses if the market does go down significantly. They also aren't totally sure how Social Security should work for them, when they should claim it, if they should do spousal benefits, if they should delay it, whatever it might be. So we'll look at a few different strategies there. And then they also would like to retire sooner than 65 if it's feasible. Again, they're just not sure about the ins and outs of healthcare and if they can afford to retire earlier or not. But their priority would be to retire earlier with less money as opposed to later with more money. So that's very important from a planning perspective as well. Now let's take a look at their financial plan in our software and go through a few different scenarios that we built out for them. So what we're looking at here is Sarah and Ian's retirement income guardrails plan. And we have a few different scenarios that we're going to go over. The first one is retiring at 65, which is their initial goal. We'll call that the baseline. And then we have another scenario where we can show them what it would look like to retire now, and then sort of a happy medium scenario where they retire in about 3 years. But essentially, a retirement income guardrails system is where we take their projected balance at the beginning of retirement. We calculate a safe spending amount that they can expect to spend each month that includes all of their different cash flows, like portfolio withdrawals, Social Security benefits later on, things like that. And we basically calculate an amount that we expect to be a safe amount to spend with a low likelihood of them running out of money. But at the end of the day, projections are just that. We don't know exactly what their portfolio is going to do throughout retirement. So the bottom part here is their guardrails. So the guardrails are saying if you see a series of strong returns throughout your retirement and you all of a sudden find yourself with $2.4 million 5 or 10 years into retirement, the likelihood that you're going to reach the end of your life with a big pile of cash in the bank is pretty big. So that's when we can tell them they can safely increase their spending, again, to get the most out of their nest egg, whether it be to give back to their kids while they're still around, whatever that might be. But we also need to maintain a plan on the downside for what to do if the market drops significantly to avoid them running out of money. Obviously, that is the primary goal. You want to have enough money to last the rest of your life. So that's a little bit about the guardrail strategy that we use for retirees. I've done several other videos on this sort of strategy in much more detail that you can check out. I'll leave a link for at the end of this video. But the long and short of it is, as long as you have a plan to make adjustments throughout retirement, you can both get the most out of your money that you work so hard for, and also reduce stress and sleepless nights, knowing exactly what to do when the market takes a dive. So basically, on their baseline plan here, their net spending after taxes per month is close to $12,000. So that's quite a bit more than they actually need. And the reason that that is so high is because a couple of things here. So if we look at their cash flow chart, we can see that that number is made up of not only their portfolio withdrawals, but also their Social Security benefits. So in the baseline plan, they're both retiring at age 65, and the plan is going to start when Sarah retires. So we're assuming that Ian retires and Sarah's income is still going to cover their expenses until they need to start withdrawing in 2032. But essentially what this chart is showing here is the different timing of different cash flows. So here we have Ian's Social Security kicking in first. That's the dark blue here. So that's that $3,100 per month. And then we're telling them that they can safely withdraw about $9,000 per month from their portfolio. And there's a couple of reasons for that. One is that it's only going to last a couple of years, taking a withdrawal of that size before Sarah's Social Security kicks in. So then it will drop off substantially to about $6,000 per month. And then the other thing is that, as you can see, this total spending line at the top here gradually decreases over time. So what that represents is retirees have been shown to gradually spend less over time on an inflation adjusted basis. So the Social Security lines are flat here because those get adjusted for inflation, but overall spending typically declines as it relates to inflation for most retirees. So those are a couple reasons why their withdrawal rate is pretty high in those early retirement years, much higher than something like the 4% rule would suggest. So that's their baseline plan. Ultimately, after we showed Sarah and Ian this plan, they don't need $12,000 per month. That's almost $144,000 per year when you consider their Social Security. So we ran some other scenarios where they may be able to retire sooner. Obviously, they're going to be able to spend less, but they, that wasn't their main concern. They would rather retire sooner. So we ran a different scenario where they actually retire now to see what the feasibility of that is. So here they have their $1.4 million saved up, and then their guardrails adjust and their spending capacity adjusts differently as well. Another thing I wanted to show you was my sort of proposed investment allocation for them. So the allocation that we arrived at for Sarah and Ian was to put about 5 years worth of their living expenses or planned withdrawals in safer assets like government bonds and corporate bonds. And that represents, a war chest that they can pull from if the market takes a dive early in their retirement. You don't want to sell those stock investments while they're down. They have 5 whole years of their planned withdrawals in those safer assets while the market recovers. So that's kind of how we arrived at about a 75-25 split. We definitely want to make sure that they're diversified among large cap, small cap, and international stocks as well. So very healthy balance here that historically has done pretty good at weathering any sort of market crisis that we'll look at in just a moment as well. So that's a little bit about their investment allocation. But so in the retire now scenario, their spending capacity is obviously much lower because they don't have $2 million to live off of, but still well above what they actually need for retirement. Now, the only thing that started to raise concerns for them was healthcare. So what does healthcare look like? Fortunately for them, they would actually qualify for healthcare subsidies or the premium tax credit because since they have that taxable brokerage account, which is going to create a very low tax liability for them as they withdraw that money, they would actually qualify for premium tax credits. I'll share a link to this calculator in the description below as well, but it's a fantastic resource for those who are planning on retiring early, before Medicare age. So you put in your state and your zip code, and you put in your expected gross income. So based on their taxable brokerage account, again, being about 80% cost basis and only 20% gains, only the gains is going to be considered their income for the year. So once again, for every $5 that they take out, only one is going to be subject to taxes. So by my calculations, if we also factor in things like interest and dividends, their income on paper is only going to be about $35,000 after they retire. So if we enter that here as their income, they have two people that need the coverage. They are only going to need to pay about $25 per month after subsidies for a silver plan. There's obviously different plans, some cost more than others, but just to show you the power of keeping your income low on paper in early retirement, it's really not going to have a huge impact on their financial plan. Now, obviously, there are some changes that could be coming to the premium tax credits and the ACA with the current administration. So we'll have to keep an eye on that. But as of right now, anyone who's below 400% of the federal poverty level, which is somewhere around $20,000 per year for a couple, there's nothing changing as far as those tax credits in this year. So overall, the healthcare piece is not going to have a huge impact on their financial plan. Again, something that we'll monitor closely, but we also wanted to take a look at their cash flow chart in this scenario as well, because we did make some changes to their Social Security claiming strategy in this scenario. Sarah was a little nervous about delaying Social Security so long if they do retire early, because she didn't want to be, withdrawing so much from their portfolio in the event that we do see a market downturn. So we ran some scenarios where they both claim as early as they can at 62. As you can see, the benefits are reduced here. So yeah, they're receiving less for the rest of their lives, but they're also, lessening the blow on their portfolio. So for a couple of years, they will be withdrawing solely from their portfolio while they travel. We might make their, accounts more conservative in that case, just to avoid major volatility while they're relying on them heavily for income. But those are some of the changes we made in the retire now scenario. So after reviewing the retire now scenario with Sarah and Ian, ultimately they were confident that they could make it work. Obviously, this is still more than they would need based on that $80,000 per year or so, but they weren't psychologically there. They weren't fully ready to retire. They don't enjoy their jobs, but they just want a little bit more of a buffer there for, increased confidence that they could retire and make this money last and live the lifestyle that they wanted to. So we ran a sort of happy medium scenario where they both retire in about 3 more years. At that point, they'll have a much healthier 1.6 million for retirement. But the main point here is that it's still nowhere near $2 million that they thought they needed. And they're going to be able to live off of more income than they even need anyway. So that was ultimately the scenario that we arrived at for them. We did revisit their guardrails for this plan, of course. We like to see exactly when changes will need to be made. So just to, drive this home again, if their portfolio were to drop to $1.1 million, that's a 30% drop. So it's not going to be super common, especially with a balanced portfolio that's not fully invested in the stock market. They would have to cut back spending by about $500 per month to prevent them from running out of money. And then again, if their portfolio increases in value to 1.8 million, they can safely start to withdraw a little bit more for more travel, start to give back to the kids, whatever it might be. So always like to revisit their guardrails and make sure that they're comfortable with those adjustments that would need to be made. Once Sarah and Ian were comfortable with a retirement date and the spending capacity that would come with that, a couple other things that we looked into for them were some tax strategies, more specifically the order in which they should withdraw from each account. Again, they're still going to be before Medicare age at that point, before 65 when they retire. So they'll still need to keep their income low for a couple years. So what they're going to do is withdraw from their taxable account first. That's that brokerage account to keep their accounts or keep their income super low. After that, they'll move to their tax deferred accounts. And then lastly, they're going to, dip into the Roth accounts last so that those have the most time to grow tax-free. And when it comes to Roth conversions, we did look at a few strategies for them. The software here is projecting out that they would save about $191,000 by converting just below the first IRMA bracket, which is about the 22% tax bracket. Ultimately, we're going to hold off on Roth conversions for now because the value that they get from those premium tax credits or the healthcare subsidies is worth much more than the tax savings for just a couple of years of Roth conversions. So we'll probably revisit this at age 65 when they're on Medicare and see what the numbers say then. But we're going to hold off on Roth conversions for now. But it was something that we wanted to let them know that we visited and took a look at. But the last thing here is a stress test. I always like to stress test retirement plans for our clients to show them, what it would look like if they were to retire during one of the worst times that we've seen historically. So a really cool part about this tool that we use here is that we can take their exact numbers. So we can take their current age and life expectancy, their investment allocation, all of their balances, and we can put them back in time and see exactly what would have happened before various different market crises. The one that I like to do is the dot-com bubble, because not only did we have the dot-com bubble, but 10 years later, we had the global financial crisis. So probably one of the worst times to retire historically ever. But, it's a good way to show the worst case scenario and that it's really wouldn't have been that bad as far as the adjustments that would have needed to be made. So on these charts here, we can see the top, which is their planned income. So their starting income would be that 11,600 or so. That's pre-tax on this screen. And then on the bottom here is their balance. So this is what their balance would be at retirement, given that they're still a few years away. So during the dot-com bubble, obviously they would have seen a pretty big drawdown, but they never would have actually hit a lower guardrail. So they would have been able to continue spending the same planned amount the whole time. And then once the global financial crisis came around, yes, they would have seen another pretty substantial drawdown in their portfolio, but they would have only really needed to make a cut in spending of a few $100s per month. And the reason for that is because obviously the markets bounced back after that, even while they were still withdrawing from their portfolios. And eventually they hit an upper guardrail. So as you can see up here, they would have been able to actually increase their spending $1,800 a month more than the initial planned amount. So this is where they can start to give back to their kids if they don't need that money, donate to charity, maybe go on more family trips, whatever it might be. So long story short, the stress test is a great way to show the worst case scenarios and that they really wouldn't have been all that bad if you just made a few minor adjustments along the way using a retirement income guardrail strategy. So this is the final piece that we showed Sarah and Ian that ultimately gave them the confidence to not only pull back their retirement age a few years, but retire on much less than they thought they needed to begin with. If you're approaching retirement and you're not fully confident in your plan or how much you'll need saved to live the retirement of your dreams, visit our website to schedule a free assessment where we will do this all for you for free to see if it's a good fit for us to work together. Other than that, thanks for tuning into the video. Subscribe to the channel for any future videos, and we will see you in the next one.